Good morning, everyone. Well, the fears that gripped the markets just a few weeks ago seem totally forgotten now. Fed tightening, the crisis in Ukraine, the slowdown in China. It seems like a bad dream that investors have woken up from. Investors who don't own Ukrainian bonds or coal stocks in China, that is. The MSCI Emerging Market Stock Index has risen for 8 days in a row and is outperforming the Developed Market Index even as the U.S. stock market renews its record high. Two fear indicators, gold and the yen, continue to fall, while U.S. bond yields creep higher. The VIX index has had its low for the year so far and is below the average level of the last year. It looks like all is well in the world, at least for now. So what impact would such a scenario have? Overnight, the dollar was mixed against both the G10 and emerging market currencies, but over time, a recovering global economy should be positive for the dollar. As the expected time of Fed tightening approaches, investors are likely to shift out of dollars and into yen and the euro as funding currencies, if they haven't already. That should support the dollar and particularly put further downward pressure on the yen and the euro. The yen seems to be particularly vulnerable. Overnight, the Bank of Japan released its first Tankan report on inflation expectations among companies. It showed they expect inflation to be 1.5% in 1 year's time and 1.7% in both 3 and 5 years from now. That shows considerable success towards achieving the Bank of Japan's goal of stable 2% inflation, but they're not quite there yet. It may mean less pressure for further easing in the near future, but it underlines the need for continued accommodation over time. Well, for today, the main event's going to be the ADP employment change for March, 2 days ahead of the month's non-farm payrolls. The report's expected to show that the private sector gained 195,000 jobs in March, which is close to the 200K non-farm payroll forecast. This could support the dollar since the ADP report is the best indication we have for the non-farm payrolls. Also, U.S. factory orders are expected to have risen in February, turning around from a fall in January. This would go along with the rise in the March manufacturing ISM and the much better than expected U.S. auto sales for March that we saw yesterday, and would continue to reassure investors about the health of U.S. manufacturing. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.